proud of being moderating this panel because I think we've got a great set of people here. There's Nupur, who represents probably one of the largest LPs in the Indian market, has been operating for decades over here, invest through funds, through direct equity, through direct lending. So again, a great perspective from that front. We have Manish and Amit, who've both been principal investors on the international side before focusing more on India in the last 5-7 years or so. And then we have Vishal, who's been probably a pioneer in the Indian private equity industry, who's been here since the late 90s, raising dedicated Indian pools of capital for private equity. So again, a fantastic panel here. I think I'm going to kick off. Obviously we all know, I think, the subject of our panel is more around fundraising and stuff. And we are going to try and cover these different perspectives here. But I think we all know in the last 5-7 years, emerging markets, 07, 08, a lot of money, a lot of capital raised. And then, came into the challenging period from fundraising, but also from a capital distribution perspective. I think I'm going to begin by asking Nupur at IFC to give her, share her perspective on IFC and how it's been operating in these markets and where they've been investing, just to sort of give us the reference point.
Thanks, Pavan. So IFC is an investor in global emerging markets, and which basically gives us an insight and access to activities across Africa, Middle East, Eastern Europe, Latin America, and of course Asia. Purely as LPs, in our capacity of fund of funds, we have we've been watching the fundraising phenomena very, very closely. What we are seeing is that global fundraising has been increasing, and 2013 numbers are definitely the highest since 2009. But at the same time, what is happening is the emerging markets portion of that fundraising has been steadily declining. So to us, it's basically indicating that LPs are looking at markets with lower perceived risks, and they are also looking at whatever is their understanding of the growth or momentum that is sitting in markets like, say, the US and Europe, given what has happened in the last couple of years. But when you sort of take that perspective and look at the declining fundraising in emerging markets and you bring it down to Asia, Asia is, it's the largest share of emerging markets, global fundraising. And if you compare it to Latin America and Africa, it is way larger. And what has happened in Asia is that it peaked in 2011 with a pretty phenomenal fundraising, but has steadily declined. And I think the 2013 numbers are back to pre-2010 levels. I don't have the exact analysis there, but they're definitely lower than 2010. So it's sort of peaked and it's going down. So there's a global envelope that is shrinking. Within that, the Asia envelope is shrinking. And within that, India and China have been competing with each other, and India has been on the shorter end. And if you just look at the BRICS context, even Brazil has overtaken India in its fundraising. Since 2011, Brazil has beaten us. So there's definitely something for the Indian market to actually think about, and I'm sure the panel is going to get into details about factors behind this slowdown. But this is what we've seen as IOC. Africa still has a slowdown. There are a lot of GPs there who are launching funds but finding it very difficult to close. Latin America attracting much lesser capital despite Brazil doing well and attracting a lot of hot money. Turkey, Eastern Europe, valuations are high, again capital is much lesser, and we are back to Asia where we see India again competing and struggling against China. Southeast is picking up, but Southeast Asia is a much smaller market, so I think when we have to think about India, we really have to map ourselves to our performance against China, and I think we're going to talk about that more.
I think just to put Nupur's description in context, I think from the MPI data for the last 4, 5, 6 years, I think you can clearly see that emerging markets has been anywhere from 10-12% of the total fundraising pool globally to, in some years it's been as high as 20%, But to Nupur's point, that's going back down to about the 10% levels now. That's a clear trend there. And one of the questions when I'm talking to my peer group at LPs, etc., is why bother with India, an Indian private equity, when US is delivering such stellar returns in the private equity context. I think with that, I want to turn to the GPs on the podium and again, talk about, maybe let's start with Vishal, because Vishal has been here in this market raising India funds since the late 90s, and including the last two funds raised very successfully in 07 and 09. Vishal, could you give us some perspective on fundraising for Indian private equity funds and how it's evolved, what your experience has been?
I think we raised our first fund in 1999 and early 2000, and we raised the last one in 2009, which is the fourth fund. So the journey through that has been very interesting. In first fund, we did not know any international LPs, so we decided to actually be the first private equity fund to raise money from local Indian institutions. So our fund one, we were able to do a first close. Our target was 50 million. We were able to do a first close of 35, only from Indian institutions fairly quickly, in 6 months. And after that, we kept the fund open for 2.5 years, and we did not get a single dollar in it. And we left no stone unturned in making sure we can get one more close, but that was the reality. Then we started raising fund two. This was early 2004. And we said, okay, let's this time target 100 million. Because our fund one was doing quite well. We got our existing LPs to quickly commit and said this time we need to go international. We had built some international relationships. And that was a time when we would meet LPs in 2004, they would say, yeah, interesting, we want to hear the story. We are going to visit India in 2006, will you be open? And obviously, given our past experience, we said, of course, we'll be open in 2006, no problem, you can, whenever you feel, please do come to India. And I was on the road for 9 months, 25 days a month. It was a tough one, but we did manage, and we managed to raise 175 million, which was, there's an interesting story there where they asked us for what is the hard cap for the fund. We are targeting 100 million. We said, what does that mean? So that is, you're not going to take more money than that. I said, okay. We are targeting 100, we never get that anyway. So you can put any hard cap. They say 150, we said great, we're never getting there anyway. And we got to 175, and that's when we realized what the value of hard cap is, because it was really tough to even get to target. Then came Fund 3. We raised that towards the end of 06, I think last quarter. Within a quarter, we had a demand of $1 billion. Our target was 400. And none of us took a flight out of Bombay to meet any LP, because partly we've been building relationships over a period of time. So people knew us, and India was really hot. Everybody wanted to pour money into the country. So that was a real breeze, and we thought life has become great now. Then we raised Fund 4. We started that in October 2008. The target was to raise 700 million. And we got all the commitments in by March, April 2009. Again, $1 billion. We did not travel out of Bombay much, because again, this was all relationships which were in place. And that was a bad time, because we had Lehman immediately after we launched. And we had terrorist attacks. There were a lot of travel advisories, a lot of LPs couldn't come for diligence. So I think that is how the thing has evolved over 4 funds. We will be looking to raise Fund 5 maybe in a year's time or so, and we think that is going to be a completely different experience. We think no longer India is a must-have for any of the LPs. So it will really a lot depend upon our track record, a lot depend upon how we are doing macro-wise. So I think Fund 5 can be significantly tougher than 3 and 4. We are hoping it will not be as tough as Fund 1 and 2. That's been our experience.
Quite interesting. I just want to add to that anecdotally. I used to cover the Indian markets as an LP in those days when Vishal was raising Fund 2, and at the back end of his fundraising, I wanted to come in with a small commitment as one of the few, international LPs. And to his credit, Vishal pushed back saying, no, I can't take it, because he had given his word to other LPs saying, I will not cross a hard cap of, I think it's 155, some number, and pushed us back. So I think credit to Vishal in those days when fundraising was so difficult. But interesting journey, obviously, Vishal, and I think we're going to also, I'd like to touch upon some of the attributes of what do LPs look for, in GPs, etc. I want to switch to Amit at CX, and obviously spin-out team from, predominantly a spin-out team from CBCI, very successful fundraised, closed on $515 in 2010. Are in the midst of now extending into the debt side of things. Hopefully shortly we'll close on the debt fund as well. Amit, what's been your experience as a firm and what's worked for you? How come you guys are so successful? Mostly being so successful.
Yeah, mostly we're successful because we try to raise when Vishal and Manish are not raising. That's a good part of the secret. But I think the markets have evolved since even we raised money in 9 and 10, and I think clearly you can see that, and I don't say this because Manish and Vishal are here, that funds and firms with distinctive strategies that are consistent, that follow, that have followed that strategy, that are building capability. There are strategies that are just purely opportunistic. When GPs describe to LPs, we're an India fund and that's what we are. Whatever will work in India, that's what we will do. I think GPs, as Vishal was saying, in 6, 7, 8, perhaps even 9, would have bought that to say, well, we want India exposure, and we leave it to you to be flexible and opportunistic about what works and what doesn't work, and you guys are the experts in this area. I think really what's happened now is that most LPs now want to hear a very consistent, well thought out strategy that allows the GP to build expertise in that strategy over time. So if you're going to do buyouts, well then do that, because even if it takes you a little while and your organization matures and the GP matures, you can the LPs will be able to see that over time, rather than a strategy that changes over time, where perhaps LPs feel that it's so time and vintage dependent at that point, rather than GP alpha dependent sort of creation that's happening. So I think that's definitely something we've seen. You alluded to our debt fund. Another thing that we've seen, of course, is that for a large portion, we believe of what used to be the universally private equity no longer really makes sense. There are still great businesses being built in India. There are still great businesses, we think even more great businesses that will be enabled by private capital when it comes in with expertise and when it comes in with other things other than capital. Like the guys to my right will definitely do that. And then, of course, there are many other places where capital is just that. It's just capital. It's a financing tool. It's last mile financing. It's this. It's that. But in the end, it's money. And we believe that for that, maybe in dollar terms, larger portion, there are different kinds of financings that you can bring, different kinds of capital that you can bring to the table, where perhaps being a partner on the bottom line as an equity stakeholder makes less sense. Being a financing solution provider makes more sense. So we've definitely seen that. Our universe, we believe, has shrunk. We still believe it's large enough to deploy capital, and we still believe that when you bring market independent alpha of some other kind to it, whether it's expertise, whether it's sector expertise, whether it's a kind of thing that you do really well, then it works. But certainly we've seen that evolution from when we raised money to today, that certainly changed.
Thanks, Amit. Let me switch to Manish now, who's obviously been a poster child of fundraising in the most recent past, and phenomenal fundraise last year at $540 million. Manish, what's been your experience? What's worked for you guys? How do you see this sort of, what would your best advice be for the people out here?
Just have friends like Amit and Vishal and Nupur. You call them, they open up all their LPs. You call them, they all commit. Nupur commits 100 million. You're done. Simple. It's just the people on this panel. More seriously, I'll just share the story. It's many of you in the room know it. I think it's the central word I'd say is passion. I think when we were three of us who co-founded this firm, and we've been thinking about it for a long time. But somehow it all clicked together around the 09, 010 in terms of what the idea was. We all knew we wanted to do something, but we didn't know what it was. And then finally, at the end of 11, early 12, we started to leave our respective jobs. People thought we were nuts. Not just people in the industry, but our own families. And it's single worst time, fundraising. What are you doing? Are you nuts? But we just said, listen, it feels right. And something gave us the confidence that we'll do it. And I don't think we're anywhere near, Pawan's got it wrong, I don't think we're anything near poster child or children or whatever it is. I think all the hard work is ahead. I think we've been given a small chance. We don't have the excuse to give that there is overvaluation or there could be currency fluctuations, but if we don't succeed in the next 3 or 4 years, the fault is only ours. So we will not be given a second chance. And that's what we're paranoid about. So some people have been generous and given us a chance, or we've been lucky in a very bad environment. If we screw it up now, we're done for good, and we realize that. So then let me get back to say what actually worked and what didn't work. I think what really worked, one was, in addition to passion, was just persistence. We had a certain idea, we had a certain approach, we had a certain theme, which we thought was very attractive, but for some reason, many of the firms were not catching on that opportunity. And, many LPs in a very productive manner, and I think it really helped refine our thinking, challenge that. But I think the good thing coming out of all that is we stuck to what we thought was right. We could have zigzagged and tacked, as you do in sailing, all over the place. We could have moved from being private equity to credit to we had people offering us early venture. It was all over the place, those conversations. And I think many of these conversations, and luckily we had heard some of those because I was in my previous avatar both a GP and an LP, because as a sovereign you could do both. And I myself was often mischievous and asked those questions, which was just testing how committed the team really was to what they were saying they would do. Or many others have said, listen, forget about this fun stuff. You guys are, too new to the table. And just, go find your deals and we'll commit money behind it. We said, no thanks. Or some said, hey, you have this partner with you guys. We have a partnership with a firm a very reputed firm called Clayton de Belair, who we learned a lot from. But leave those guys aside. We don't need them. If we don't have them, we'll come in. And it was tempting at a certain time. But we said, no, we're going to stick to what we believed was right from day one. Obviously, we kept refining that approach as we got the feedback. It was passion, it was persistence. And then we finally, it was a lot of luck. And I do think that if you have a credible story which is backed by, well, ideally should be backed by something what Vishal has is a degree, a number of funds where you show your track record as a fund. But even if you don't, what worked for us is all of us have been private equity for a relatively long time. Well, in the Indian context, a relatively long time. I still consider myself very young, unlike Ajay and the rest of the CX team. But all jokes aside, the important thing was the investors could see that we had a track record, and they actually went and spoke to almost each and every one of our previous investments. It was very helpful that the firms we came from were very supportive and said all positive things about us, because that would have been the kiss of death if they had said something negative. The other stuff was, I'm not patting ourselves in the back at all, but there was this whole thing of integrity. It's we've heard many disaster stories, especially in emerging markets, especially in Asia, and this was the time when some of the deals were blowing up in India for bad governance reasons. And I think something about our backgrounds gave them comfort, that we'd stuck to our same job for 10 odd years, we'd come from certain institutions, yada, yada, yada. So it was a combination of all that, which combined in a very lucky manner, where we not only crossed our target, but we reached our hard cap. But as I said, We are humbled by that. We think we're lucky, and it makes us all the more paranoid because we know that if we're given one chance, we better hit it out of the ballpark or we would die.
I think that's quite fascinating. As I think about it from an LP perspective, I guess LPs are looking at broadly 3 categories of things, right? When they're doing their due diligence, they're looking at what's the strategy, they're looking at what's the team and the organizational structure around the strategy, and thirdly, what's the track record. Nupur, could you give us some insights into how you see these 3 parameters and what, say, weightages you attribute to each of these, if these are really the 3 things you look for, and how that has evolved over this period of time, sort of 06, 07 when you started doing this at IFC, and then today, and where do you attribute more weightages today than previous days?
I think it's extremely difficult to actually assign weightages. We think all 3 are equally important. But I think the big difference between 2006, 2007 and now is that the third factor, track record, is a little more available and a little more visible today. So back in 2006, 2007, there was the 2001 to 2005 period where private equity had done extremely well, and there were some extremely high double-digit IRRs that had been generated. The India story was extremely positive, the macro was good, the growth was good, the economy, Ruby, everything was good, and there was a lot of money flowing in. And there were a lot of new GPs that were setting up shop. Now, as IFC, we are quite comfortable backing first-time teams and first-time fund managers. And we've had a great experience with that. I think about 50% of our top decile performers are from first-time funds. So, we were able to very actively participate in the market in 2007, 2008 and back a lot of solid GPs and solid teams. But what has happened now is that all of those teams have gone through an investing cycle. Not a divesting cycle, but at least an investing cycle. And what has also happened is because the market is so tough, marginal players are sort of beginning to fall off and the noise is reducing. So what we're seeing in the market today is, you could call it consolidation or you could call it correction, but what we're seeing today is that LPs have a greater ability to evaluate track records as compared to 2007 and 2008, and I think that has just made things a little different now, because now the questions are much more directed and the concerns are all, much more clearer.
I think one of the points you mentioned yesterday, Nupur, is also the fact that IFC has a lot more flexibility around the time horizons, and because it's balance sheet investing, and it's not it's not pushing the GPs to after year 4 saying, okay, where are the exits, where are the exits. So I think that's an advantage from an LP's perspective as well as for the GPs, I guess.
I mean, if I can just expand on that,
please.
The caveat there is that we need to see continued growth in the underlying portfolio. So as long as there is value creation, value accretion, we are willing to be patient.
Sure.
That's important.
Sure. At the same time, I'm sure, in the LP world, when I'm talking to my older peer group, there's a lot of intrusion and intrusiveness in the way LPs are today analyzing GPs and fundraising, and it's literally nothing short of sort of opening up the kimono, and particularly in a difficult market where exits have been challenging in a market like India. There's increasing sort of it's a very tough ask to go out and fundraise. What's in that context of, again, the last sort of cycle? How has, let's say, Vishal, how has your model evolved? What are you doing differently today than what you were doing sort of 5-7 years ago?
In terms of our strategy, we defined our strategy way back in 1999, and we have consistently just stuck to that. In 2011, we did feel that the world around us has completely changed. India has completely changed in 10-12 years we've been operating. Private equity has changed, so it's time for us to step back and take a fresh guard and figure out if what we are doing is still good or should we be doing something different. And we spent almost 6 months doing that internally with help from outside, and came to a conclusion that our strategy was not very necessary in the last 10 years, which was from 99 to 2011, but is going to be one of the very appropriate strategies going forward. So we should really not change anything in our strategy, but there was significant scope for improving on execution. So when we looked at the value chain, starting from deal sourcing to underwriting to how we work with companies to exits, we thought in all areas there was a lot of scope for improvement. So we came to a conclusion that we should just stick to what we're doing, but just make sure that we polish the apple more or execute much better.
Amit, what about you at CX? Have you guys sort of changed or doing anything fundamentally different from when you set it up?
You know, I think just to add to what Vishal was saying already, you know, I think our strategy has been pretty consistent. There have been minor tweaks in response to, you know, kind of, you know, macro events, like we said. Maybe there are certain sectors, you know, that for us are no longer, you know, inbounds, you know, certain sectors that we may think are out of bounds. And that, again, is not forever, you know, it's just what we think today. You know, we're not a sector-focused fund, we're sector-agnostic, but that doesn't mean we're not sector preference. You know, we have our, you know, clear preferences, themes that we think make sense. And maybe they change, but not quite so frequently, maybe every few years. I think one of the other things that I think, you know, definitely has, you know, maybe people are more acutely aware today than they were perhaps before, you know, and I think increasingly becoming more aware, you know, one of the things is the liquidity profile, is, you know, how liquid, ultimately, how monetizable ultimately is your portfolio. One, of course, is value creation, is the portfolio growing, EBITDA growing, you know, but can you eventually get out of this, you know, and how much time will that take, and, you know, what does that feel like? And certainly that's been something where I think, to go back to where you started this question, LPs are focused more on, GPs as a whole are focused more on, which I think is a very healthy development. And I think that, you know, going forward, you'll find that, you know, I separate sort of, you know, investing into two parts. You know, you can call one kind of equity research. You know, what's a good business? Is this a great business? Is this a great management team? Is this a great sector? You can do all those things, and that's certainly, you know, really required. But beyond that, I think, is this the right construct? You know, can we monetize this investment in our time horizon? You know, in our investment horizon, and that, of course, also changes at various parts of the fund. You know, on day one of your fund, when you've got 10 years in front of you, that may look different than on, you know, year 5 of the fund. You know, when LPs really, you might have 10 years, but they want their money back in, you know, 7 or 8. So that's, you know, the construct starts to make a big difference, and I think Indian GPs certainly, you know, I think have increasingly focused on construct rather than just on the other things that I mentioned.
Manish, as you're the one who's just freshly come out of the fundraising mode, could you give us examples of sort of one or two, the toughest questions that you faced from, you know, from the LPs while you're fundraising, and how you sort of got over those things?
So I'll just get to your question in a second. I just want to continue the thought about the strategy. I think from our perspective, we are the new kids on the block. So there's no question of changing the strategy. But I think even as we stick and focus purely on the strategy that we've formed, we're seeing many tangential opportunities. So just to step back to the guys, our thought was in the large business groups, if you don't focus on the 1 or 2 large businesses, there are a plethora of other businesses which are not performing to full potential, where we could add a lot more value. We were surprised to see that in addition to that, which is our core strategy, there's a significant number of first-generation entrepreneurs who also have a similar belief. So in a sense, our pipeline has almost tripled, which is what our great surprise was. So again, this was sticking to the same strategy, but in a sense, getting a free option. I think the other thing which is going to change for us, and this is one of the things we told our LPs, was the environment. I fundamentally believe, and I think both Vishal and Amit will probably, as a vintage, we're stepping into the next 2 or 3 years, which should be a really good vintage. There is the plethora of capital which existed in 07 is not there. I think each of us, I would say definitely myself and my old job, many of the others, we had much sharper elbows. We were going out in term sheets in much quicker levels that we should have in retrospect. I think we've all learned from that. There are fewer number of people out there. And I think the big difference this time around, it seems to me in its early days, and it's happening already, is you'll see a lot greater level of collaboration amongst us, amongst GPs of our similar, north of 300-400 up to 1 billion, collaborating and doing a lot of stuff together. And also buying and selling assets to each other. I think that whole industry is evolving. And there'll be many different types of private equity. It's not just the smaller minority stakes, but each of us will be looking at stuff, and instead of elbowing the other guy out, I think we'll probably err on putting a smaller capital commitment ourselves and getting somebody else on board to share more importantly, to share the rewards. But then back to your question, I think the two questions which always come up, and I think there's no right answer for this, is the macro, is India. And our job was always, I think you can't answer that question, you can't defend the country, you can only talk about yourselves. So you've got to avoid that question. We had multiple situations, it was really funny because the place is that we thought we were closest to often didn't come in, the place we didn't think we had a chance came in. So it's this whole game, as we all know, is unpredictable. But there are many situations where, we love these, we had McKinsey guys say why India should not be invested in, why should go to China and Brazil. That presentation was made to the board the day before we used to get there. And so that's a huge question that everyone who's going out there needs to answer and have a good answer for. And for us, the added disadvantage, of course, which Vishal won't face and neither will Amit, is we were seen as a first-time fund. And while Nupur is more generous and looking at them, I think with many of the institutions out there, that's just a no-no. And it hadn't really struck us, we hadn't really thought through this. But as you analyze it and you look at the history, it makes complete sense. So I would say for the guys who are going out there for the first time, the hurdle is that much higher than just the India hurdle.
I just had a question on the first comment that you made about the opportunity or the strategy, that it's slightly different and the universe is much larger for you. Are your LPs flexible? Do they give you enough flexibility to actually go after that slightly different tangential opportunity set as well? Because I've known several cases where sometimes the GP is well aligned as well, and the GP wants to do something which is slightly off the charted territory or stated strategy, and then the LP sort of clamp it down. So what's been your...
We've been really fortunate, luckily. Our LPs have been very active in some of the co-investments we've shown, but haven't really stopped us or even hinted at. And we've been very honest and very upfront. We share our deal, especially when there's a co-investment with our LPs on day zero. But I think the reason we haven't got that is we haven't actually stayed away from our stated strategy. We've just said why the opportunity set has become bigger, and actually why the price, the valuations are actually more attractive when it's not a large family group, but it's actually an entrepreneur who's having a generational issue or a succession issue. So in our case, I think we've been okay so far. I think tomorrow if I say I want to go and buy 2% of Infosys, I'll be surprised if they let me do that. Right? So I think as far as you sticking with the bounds of the strategy and are very open with what you're doing, I think in the most cases you're fully aligned, and they leave it to you.
Right. Okay. We've got probably less than 10 minutes. I just want to remind the audience that if you have any questions, feel free to send it over. I'm going to switch tracks to actually, talk a little bit about the future of fundraising, future of Indian private equity, and start with Nupur in terms of what's the plan for the next few years, what's ILC's thinking as far as fund commitments is concerned.
Like I said, we are investors across emerging markets. So when we look at the challenges that India is going through, we don't think they are so unique that no other economy would have gone through them or would not have to sort of go through them again. So these are pains that developing economies go through, and every country sort of takes a different path, a different cycle. So we continue to have confidence that India is going to turn out well. In terms of the fund of funds program, we don't have a yearly allocation. So it's not that every year we sort of sit back and decide 10% of our assets are going to get allocated to fund of funds this year. We have a constant allocation that we look at it is obviously deployed based on the opportunity available and the quality of the pipeline. But for us, it's usually more of a micro GP level decision as compared to a macro decision because of the reasons that I mentioned earlier. All of our markets have different kinds of challenges, and most of those challenges are related to the macro. So for us, the decision making is more around the micro, the GP, and what investment is on the table, and we'll continue to do that.
What are your standard sort of sweet spot of bite sizes and?
Our mainstream strategy is to back funds that are targeting SMEs. We usually look at sub $300, $350 million funds, and that's primarily because we are a DFI. And one of the things that we don't want to do is compete with commercial capital. One of our key roles is to create access to commercial capital. So Manish, for example, he doesn't need my $100 million check. So,
I welcome that. At the end of this
I
session,
think Nupur is stepping back from our commitments. Huh? I'll tell you that lunch right before this, she committed capital to all three of us, which is why we're here. And now she's saying she's not looking at funds more than 300 million. So there's some discrepancy here, which I would request the moderator to correct.
we'll do a part A and a part B fund. Right? We'll keep it this way.
there is always a before and after.
I had a question from the audience, and I presume it's more towards the GPs. What is your experience of local LPs? And I think, Vishal, you've raised money from local LPs, so could you comment on that, please?
Our first fund was only a rupee fund, and post that we haven't spent much effort building the local LP base for primarily the following reasons. We think there are very few institutions who have the flexibility to invest in private equity. And even though they have the flexibility, their entire underwriting capability and the team is not geared to commit a lot of money to private equity fund. So it is a lot of effort, and the amount of money one can ultimately raise is quite small. Maybe $100 million can be raised from institutional LPs in India, but it will take a long time. And they're largely public sector banks, and they have their own process, which is extremely frustrating. So we have not invested a lot of time and effort in building that relationship, but we do recognize that we can't as a country be relying only on foreign capital as an LP base. So we need to work harder to grow and build that base, and we do want to invest that time going forward. So it's still quite challenging. There are still few pockets as institution. HNI is a separate sort of a class of LPs which is certainly available to tap but has their own challenges. But if somebody is looking to raise a substantial amount of capital, 100 or 200 million dollars, and institutional capital is very critical. And that needs to grow. We are trying to talk to all the relevant influencers and regulators to say that it is a good asset class where larger pension funds, insurance companies, they should be allowed, and the regulators should actually encourage them to invest versus have conditions which are so onerous where they just don't find it attractive to invest. So I think it's a tough road ahead there, but something which is very necessary. And we all all the GPs and as an industry need to work towards making it a more attractive pool.
I would agree in terms of what I've seen in China and Brazil and Russia, for example, is that local pool of capital has been pretty strong and has supported the domestic industry. And in fact, to the extent that I think in China, what's also happened is the R&D capital pools have a slightly different, obviously, risk-return take on things, but are quite dominating. And then the regulatory aspects as well sometimes favor the local capital over the dollar capital, for example. So it's it's good that I mean it's an opportunity there that the Indian institutions need to get going and need to encourage them somehow. I want to come back to that question of mine originally and maybe ask Amit in terms of fund structures and terms. And there's a plethora of discussions nowadays, not necessarily around 2 and 20 and 8, there's a sort of pressure around all those three numbers, as well as around fund structures by themselves. There's a lot of chat about co-invest funds, pledge funds, separate accounts. What's been your experience, and you're currently in the market on this debt fund? What's been your experience, and what's the way ahead, do you think? What's the way forward?
Sure, let me try and answer that in two parts. One, of course, is on the credit side. I think where we certainly, as we were talking at lunch, have decided to take our hurdle up to 9% rather than 8%, which had perhaps less to do with LP pressure to move the hurdle up, but more from our side saying, a 9 net number is actually possible on the credit side in dollars. And then obviously in a fixed return product, I think people are more concerned about currency depreciation and things like that, where perhaps your underlying portfolio, even though it might be growing, you're only getting a fixed return, from those investments. So that's on the credit side. In fact, but on management fees and on carry and carried interest, at least our experience so far has been that as long as the three things that you kind of checked off before, which is kind of team strategy and track record, I think that's still largely where the focus is from the LPs. And I think the LPs, if they're convinced on those three, I think fees are not what's going to move the needle one way or the other. I don't think LPs are going to come back and say, we love your team, we love your strategy, we love your track record, but 2s and 20 isn't cutting it for us. That's where the decision isn't really being made there, at least, or vice versa. Or vice versa. If the other stuff doesn't work, but it's a less than a 2s and 20 fund, I don't think you're getting much LP interest in our view. That's not to say that for the larger funds, as your fund, as your AUM gets large, you may get LP saying, look, just to align interest more than anything else. Not because we think of anything. Maybe you ought to think about reducing fees just because we feel like there's 2 or 3 accumulated funds, as Nupur was saying, over lunch. That definitely is the case. We certainly are not there yet, to feel that, but that could definitely be something that happens. So I think I would just go back, and obviously, Vishal and Manish can jump in, but I would just go back and say what we're seeing from our LPs is a much more rigor around the first three, and less, at least at the moment, any pressure on fees. I don't think that's been the case for us, but I'll let everybody else.
Manish, you alluded earlier about some discussions around people saying, institutions saying, we'll do a pledge fund type structure, find the deals and we'll put the money behind. What was your thinking there? And particularly as the first time fund, how did you sort of resist that pressure?
No, so I think it goes back to what Amit said. If the first three things aren't working, nothing else will. So I think I would say the questions around the pledge fund or you don't need a JV partner, etc., were probably done by those LPs. In retrospect, at that time you had no clue. But in retrospect, done by guys who were already on edge, who were uncomfortable either the India store, the macro, or something of these three things didn't fit. Right? And then I think even if the decision made very early is if we go down that slippery slope, that's where we will spend the time on rather than on the strategy, right? And our strategy and the India story was complicated enough. We didn't want to open up one window. And I do really believe, and it's been said by all before, that these guys, at least the global guys, are so large that we're a pimple on someone's, cheek or wherever, and for them to recreate that economics for us, they know that if they choose the right team, the right strategy, the returns will be significantly more than micromanaging and tweaking the stuff, right? But I do think that as the funds grow larger in size, as you see in the US, I think the 20 will change, I think the 2 might change, and I think, as Gopal was saying outside, I think the 8, in the Indian context, as you look at rupee funds and what alternatives Indian investors have. I mean, for your rupee capital, there may be a different economics.
Nupur, do you have a view, just as a final comment, on the hurdle rate of 8% and whether it should be fixed or floating, and if it's fixed, is 8 the right number?
It's very difficult to say that 8 is the right number, and maybe somebody with a fixed return strategy would not think 8 is a good number. The way we look at hurdle is as a tool of creating alignment and incentive for the GP to perform. So the hurdle has to be high enough to push the GP to deliver returns beyond a certain level. So if you're looking at 8% or 10% hurdle, you're basically trying to incentivize the GP to earn double-digit IRRs or double-digit returns. But at the same time, it cannot be so high that if things don't work out as well as everybody had expected, the GP sort of starts to say, oh, I'm never gonna make the hurdle, I'll never get any distribution, so let's just let everything go. So it's a fine line there. We don't really link it as much to cost of capital. I think it's very difficult to say what's the right number. Depends on the strategy. Growth funds, I think, are typically happy with 8 to 10% IRR in India for the last couple of years.
I think on that note, we're going to end this panel, and thank you to all my fellow panelists, and I'm sure all the GPs here are eagerly anticipating the check from Nupur, so we'll welcome that now. Thank you, thanks to everyone.